Welcome to the deep dive. Today we're tackling some pretty complex corporate documents, specifically from SBI Life Insurance. We've got their performance update for the first half of fiscal 26, so that's ending September 30, 2025.
That's right, a major player in a really dynamic market, India's insurance sector.
Okay, let's unpack this. Our goal here isn't just, reading out numbers. We want to get behind them. We need to figure out the key metrics, things like embedded value, new business margin, to really grasp the financial health and the strategic direction here.
Absolutely. And these results, they were approved and out by October 24th, 2025. And you're right, looking past the headline, profit after tax, the PAT, is crucial for insurance. You really have to track things like value of new business VONB and annualized premium equivalent, APE, to gauge that long-term health. It tells a different story.
Got it. So let's start with those headline figures, just for context. Comparing this half to last year, PT grew 4% to $10.9 billion. That feels steady. But you're saying that 4% isn't the main takeaway.
Well, yeah, exactly. It's modest growth on the profit line today, but the story is more about scaling up for future earnings. Look at the sheer volume they pulled in. Gross written premium, GWP, jumped 19% to a huge $429.0 billion. That's significant growth.
19%. Okay.
What's really driving that? A 21% surge in renewal premium.
So existing customers sticking around and paying up, that points to retention, customer satisfaction maybe.
Precisely. Retention is fundamental, and that scale feeds into their assets under management, the AOM. That grew 10% to a monumental euro 4.8 trillion. Just think about that scale for a second.
0.8 trillion. Wow, that's a lot of capital they're managing.
It really is. It shows the kind of long-term savings power they command in the Indian economy.
Okay, but with that kind of volume, asset quality becomes paramount, right? How are they managing the risk on the investment side? What do the reports say?
They're playing it very safe, very conservative. They state about 95% of their debt investments are in AAA-rated or sovereign instruments.
95%. Okay, so that's a fortress balance sheet approach. Capital preservation over chasing yield.
Exactly. And you see that reflected in their capital position, too. Net worth is up 13% to $182.9 billion. And crucially, they maintain a very robust solvency ratio of 1.94.
Right, 1.94. And the regulatory minimum is only 1.50, isn't it?
It is. So they've got a substantial buffer, a very comfortable cushion.
Which signals confidence, I guess, not just for now, but for handling future growth, too.
Absolutely. Confidence to underwrite more business, which brings us neatly to the really interesting part, the value drivers.
Okay, this is where we look beyond just stability and towards future potential. Here's where it gets really interesting. You mentioned VONB earlier, value of new business. What's the story there?
So VONB, which is that key measure of expected future profit from new sales, it grew a healthy 14% to $27.5 billion.
14% growth in future profit expectations.
Okay. But what's even more revealing is the quality of that growth. Look at the VONB margin. That's the profitability per unit of new business written. It actually improved to 27.8%. It was 26.8% last year.
So they're not just writing more business. Each piece of new business is fundamentally more profitable.
You got it. They're squeezing more future value out of each sale. And they did this while still growing the overall volume.
Right. The annualized premium equivalent, APE, that key sales metric, it still grew 10% to almost $100 billion.
Yeah, $99.2 billion. So better margins and higher volume. That's the sweet spot.
And that solidifies their market position, I assume?
It does. They maintain their leadership in the private market, 22.6% share based on individual rated premium. But, there's one figure in this report that's it's genuinely mind-boggling.
Go on.
The growth in total new business, sum assured. The total amount they've promised to potentially pay out on new policies, it grew by 99%. Yeah, 99% to over $7 trillion.
Wait, double sum assured? In just 6 months. That sounds huge, obviously. But doesn't that also sound like a massive spike in risk exposure?
That's the critical question, isn't it?
How does nearly doubling potential payouts align with improved profitability?
Well, if you saw that 99% jump without the margin improvement, then you'd worry about underpricing, about taking on bad risk. But the margin did improve, and remember that super strong solvency ratio.
Right, 1.94.
Exactly. So this explosive growth in sum assured points to a successful strategic shift. They're selling more high sum assured products, specifically protection plans, and maybe some annuity plans. These products naturally have bigger sum assured figures than simple savings plans, but crucially, if priced right based on mortality risk, They are very valuable long-term business for insurers.
Okay, so the type of product they're selling explains both the huge sum assured number and the better margin. It's not just volume for volume's sake.
Precisely. It shows the market has massive confidence in SBI Life's ability to handle these complex long-term risks, and it links back directly to strategy.
Which brings us to the how. How did they achieve this? Distribution channels, product mix?
Right, the how, well, a huge chunk is still their traditional strength. Bank assurance.
Yeah.
Selling through bank branches. That's 57% of their APE mix.
57%. Relying that heavily on one channel, primarily State Bank of India, doesn't that feel like a concentration risk?
It's a fair point. If SBI priorities shift, that could be an issue.
So how are they hedging against that?
By diversifying, and it looks like it's working. The agency channel is still significant at 29%. But look at the other channels. That's 14% of the mix now. And the individual new business coming through those other channels, it grew by a massive 36%.
36% growth in other, so that's likely digital, direct sales, maybe partnerships.
Exactly. Those channels are growing fast, which gradually reduces the dependency on the traditional bank model.
And the strategy itself, the MD and CEO Amit Shingran specifically mentioned a shift towards what was a guaranteed, non-par savings and protection solutions.
Yes, that lines up perfectly with the margin improvement we saw.
Because these products lock in stable, predictable returns, moving away from market volatility.
Precisely. That shift is likely the engine behind that improved VONB margin. But, a great strategy only works if your customers actually stick around.
Which leads us to persistency in operations, customer retention.
And the numbers there look pretty solid. 13th month persistency improved slightly by 70 basis points to 87.1%.
So 87% of customers are still paying their premiums after the first year. And the surrender ratio, people cashing out early, that dropped a bit too.
Yeah, down from 6.5% to 6.0%. Keeping customers is key to realizing that full VONB potential you locked in at sale.
Makes sense. Keep the profitable business on the books.
And in today's world, keeping customers happy often comes down to making things easy. Technology. And their investment here seems, well, quite impressive. They report near total digitalization of sourcing. 99.6% of individual applications came in digitally.
99.6%. Wow. So almost no paper for new business applications. How does that tech focus, the automation, directly feed into the better margins and persistency?
It's cost and speed, mainly. Digitization slashes acquisition and servicing costs. That directly boosts the profit margin calculated in the VONB.
Lower costs, higher margin. Simple enough.
And for persistency, quick, efficient digital service makes it easier for customers to manage their policies, pay premiums, get queries answered. It reduces the friction that leads to lapses or surrenders. They gave specific examples too, deploying 356 RPA bots, robotic process automation.
Right, automating repetitive tasks.
Yeah, streamlining hundreds of processes. Plus, they've got a Gen AI assistant in their chatbot now, RIA, for instant customer service.
Okay, AI chatbots, RPA, sounds efficient.
And the core metrics back it up. A 99.0% death claim settlement ratio that builds trust. And a really low grievance ratio, just 6 per 10,000 policies.
Very low complaint rate.
It paints a picture of a digital-first, customer-focused operation. And that feeds the financial results.
Yeah.
Even their main channel, bank assurance, is now 99.9% digitally sourced.
Okay, so internally, it looks like they're executing really well. Digital efficiency, quality new business, improving margins. Let's zoom out now. So what does this all mean? How does this fit into the bigger India story? Why is this company seemingly so well placed?
Well, fundamentally, they're riding a huge wave. India's demographic and economic story, the underlying tailwinds are just incredibly strong.
Right. The report mentioned the demographics. Huge young population, median age around 28. That's a massive group entering peak earning and saving years.
Exactly. And you couple that youth bulge with rapid urbanization, rising incomes, it's a perfect setup for insurance growth. Plus, the market is still relatively untapped. India's life insurance penetration, that's premium as a percentage of GDP, is still way lower than regional peers like Malaysia or Thailand.
So a massive potential customer base that's currently underserved.
Wide open. And it's not just potential, it's accelerating. Swiss Re forecasts premiums in India growing around 9% annually in real terms.
9% real growth. That's huge. And they project India jumping from the 9th to the 5th largest insurance market globally by 2032.
That's the forecast. And it's not happening in a vacuum. Policy helps. The MD and CEO specifically mentioned the government's GST reforms as being positive, helping push towards that big goal of insurance for all by 2047.
So government policy and private sector growth aligning, that's powerful.
Absolutely. And remember that strategic shift we talked about toward guaranteed products?
Yeah, the non-par and protection
That
focus.
positions them perfectly for what might be the single biggest long-term opportunity: retirement savings.
Ah, the pension gap.
Exactly. India's pension assets to GDP ratio is incredibly low, something like 3.1% back in 2022. Compare that to developed countries. It's a massive gap.
And people are living longer post-retirement, too.
Right. Life expectancy post-60 is now up to 22 years. That creates soaring demand for predictable, reliable income streams, annuities, long-term guaranteed products. SBI Life's product strategy seems tailor-made to capture that coming wave.
Okay, so it looks like exceptional internal execution meeting massive, favorable long-term macro trends. A strong half year, clearly driven by digital, by quality business, and perfectly placed for India's future.
It certainly looks like a phenomenal performance, yes.
Yeah.
But no deep dive is complete without acknowledging the external risks, things totally outside their control. We need to look at their own sensitivity analysis. How vulnerable are metrics like VINB and embedded value, or IEV, to outside shocks?
Right, those analyses always show how even the best ship can be rocked by a big enough wave in the global economy.
They really do. And SBI Life highlighted a couple of key sensitivities. First, equity markets. A 10% drop in equity value would knock about 2.4% off their embedded value. Market volatility risk.
Okay, 2.4% impact from a 10% market drop. Manageable, perhaps, but real.
Manageable, but yeah, it's there. Second, and maybe more relevant given current global trends, is interest rates. If their reference rate, think of it as a proxy for prevailing interest rates, goes up by 100 basis points or 1%, their IEV would decrease by 3.4%.
A 3.4% hit to embedded value from a 1% rate hike. That's quite sensitive.
It is. And it leaves us with a final thought, really a question for you, the listener, to mull over. While SBI Life seems to be nailing its domestic strategy, operations, distribution, product mix, its long-term value creation is still quite exposed to global financial weather. So how might things like continued interest rate hikes, perhaps driven by central banks in the West, ripple through and affect the profitability of even really well-run Indian insurers like this? Given that sensitivity data, especially the 3.4% impact from a 1% rate change, what external economic indicator, maybe a specific interest rate benchmark or an inflation measure, should you perhaps be tracking most closely if you're trying to project their future embedded value? Something to think about.